Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 125, and in this episode we're reviewing the performance of the global markets during the 37th week of 2024, and that is from Monday the 9th to Friday the 13th of September. And without further ado, this is your host Jamhuri, and together, let's dive right in. We kick it off in the Eurozone, where on Thursday, the European Central Bank delivered its second 25 basis point interest rate cut for this year. The widely anticipated rate cut comes after a period of sluggish economic growth across the Eurozone and cooling inflation, which fell back towards the central bank's 2% target rate in the month of August. For many market participants, the big question was not whether the European Central Bank would cut rates in September, but whether the central bank will provide any clues as to what follows next. The central bank's governing council said in a statement that it is not pre-committing to a particular rate path, while reaffirming the need to take a data-dependent and meeting-by-meeting approach. The European Central Bank's meeting comes just days before the Federal Reserve appears poised to start its own rate-cutting cycle. And over to the United States, according to a Labor Department report that was released on Wednesday, inflation in the month of August declined to its lowest level since February 2021, setting the stage for an expected 25 basis point rate cut from the Federal Reserve. According to the Bureau of Labor Statistics, the Consumer Price Index, which is a broad measure of the cost of goods and services across the U.S. economy, this increased by 0.2% for the month, which put the 12-month inflation rate at 2.5%, which was the lowest level in 3.5 years and was down from 2.9% in July, and was also slightly below the consensus estimate for a rate of 2.6%. However, the core consumer price index, which excludes volatile food and energy prices, this increased by 0.3% for the month and by 3.2% over the past 12 months, which was in line with the consensus forecast. According to the Fed Funds futures, traders are now pricing in about an 85% chance that the Federal Reserve will approve a 25 basis point rate cut at its policy meeting this coming week. And moving over to the United Kingdom, flash figures published from the Office of National Statistics showed that on a month-on-month basis, the UK economy remained flat in the month of July. This was the second month running that the UK economy recorded no growth, as the gross domestic product came in at 0% vis-a-vis economists' expectations for a growth of 0.2%. However, in the 3 months to July, Britain's economy was up by 0.5%, which was slightly below the 0.6% growth that was recorded in the second quarter, ending June 2024. The UK economy has recorded modest but steady growth so far this year, after emerging from a shallow recession in the fourth quarter of 2023. In the US stock market, stocks rose on Friday as both the S&P 500 and the Nasdaq Composite posted their strongest weekly performance of 2024, and this comes just days before the Federal Reserve's policy meeting. Wall Street is now looking ahead to the Fed's policy meeting on the 17th and 18th of September, where the central bank is widely anticipated to reduce its benchmark interest rate by 25 basis points. The S&P 500 climbed 0.5% to close at 5,626, whilst the tech-heavy Nasdaq Composite added 0.65% to end the day at 17,683, and the Dow Jones Industrial Average jumped by 297 points to settle at 41,393. On a weekly basis, the Dow advanced by 2.6%, whilst the S&P 500 and the Nasdaq Composite rose by 4% and 5.9% respectively, as both indices recorded their best week so far this year. In the US bond market, Treasury yields slipped on Friday as investors began to shift their focus to the Federal Reserve's upcoming policy meeting. The Consumer Price Index for August came in at 2.5%, which was the lowest rate since February 2021, and this data confirms that inflation is indeed slowing down and supports the case for a reduction in interest rates. The Federal Reserve is widely expected to cut interest rates, and according to the CME's FedWatch tool, traders now pricing in a 59% chance for a 25 basis point rate cut and a 41% probability for a 50 basis point reduction. The yield on the benchmark 10-year Treasury bond was down by about 2 basis points and was trading at 3.66%. Whilst the yield on the policy-sensitive 2-year Treasury note fell by about 6 basis points to settle at 3.58%. For your information, bond yields and prices have an inverted relationship, and 100 basis points is equivalent to 1 percentage point. In the commodity markets, oil prices fell on Friday as crude oil production in the Gulf of Mexico resumed following Hurricane Francine, which had shut down about 42% of the region's production capacity. However, as at Friday, crude oil production and refining in the Gulf of Mexico was back at full capacity. For the week, the price of the international benchmark Brent crude logged an increase of about 0.8% to settle at $71.61 per barrel, whilst the price of the US benchmark, that is West Texas Intermediate crude, this registered a gain of about 1.4% to close the week at $68.65 per barrel. In the precious metals market, the price of gold continued to push higher on Friday as bullish momentum fueled optimism that the US Federal Reserve was on track to cut interest rates at its policy meeting this coming week. Markets have fully priced in a rate cut this coming week with a 59% chance for a 25 basis point rate cut and a 41% chance for a 50 basis point rate reduction. As the major central banks begin to ease monetary policy, the price of gold is expected to continue surging to record levels as lower interest rates tend to boost the demand for these non-yielding assets. In response to these changes, the price of spot gold was up 0.9% and was last seen trading at record levels of $2,582 per ounce. We now change scene to the Kenyan financial markets. We start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling traded broadly sideways versus the US dollar. And according to data obtained from the Central Bank of Kenya website, the official exchange rate for the US dollar was quoted at 129.18 compared to 129.19 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a narrow range of between 131 to 133 shillings. The lowest rate was quoted at 131.50 and was offered by both Bank of Africa and Stanbic Bank, whilst the highest rate was offered by NCBA Bank at 132.50. Meanwhile, the sterling pound was priced at 168.55 and the euro was valued at 142.30. And on the regional front, one Kenya shilling was changing hands for 28.80 Ugandan shillings and 21.06 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.33. Over the past 6 months, the Kenya shilling has been relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak. This is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. Despite these fundamentals, the shilling remains relatively stable versus the major currencies. However, in the event of any external shock, the shilling is likely to depreciate sharply given our current debt position and the lack of political will to deal with corruption in the country. If the status quo maintains, then it is only a matter of time before we eventually default on our external debt, and this will send the country into an economic tailspin, which will take decades to unravel. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased significantly by a whopping $241 million to $7.74 billion, which is equivalent to 4 months of import cover. This level of reserves is now in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our unsustainable external debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently well-funded and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by just 7 basis points to 12.66%, up from 12.59% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 34.2 billion shillings, and this was up from 25.5 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 13.8 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 12th of September, and the central bank received bids totaling 21.3 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 89%. The central bank ended up accepting 19.9 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 1.75 basis points to average out at 15.75%, whilst the 182-day rate remained unchanged at 16.62%, and the 364-day rate was a shade lower at 16.81%. In the international market, during the week, the yields on Kenya's Eurobonds were on an upward trajectory and increased by an average of 24 basis points, with the yield on the 7-year 2019 Eurobond increasing the most by about 40 basis points, as it rose from 10.1% recorded the previous week to 10.5%. At the Nairobi Securities Exchange, during the week, the equities market recorded a mixed performance, with the NASI gaining the most by 0.7% and the NSE 20 gaining by 0.4%, whilst the NSE 25 and the NSE 10 each declined by 0.2%. This takes the year-to-date performance to gains of 21.2% for the NSE 10, 19.6% for the NSE 25, 15.6% for the NASI, and 13.6% for the NSE 20. The market's performance was driven by gains recorded by large-cap stocks such as Safaricom, British American Tobacco, and Bamburi Cement, which increased by 3.4%, 1.3%, and 0.9% respectively. This performance was, however, weighed down by losses recorded by other large-cap stocks such as NCBA Bank, KCB Group, and Stanbic Bank, which declined by 7.9%, 3.9%, and 1% respectively. Up next is our topical issue, and this week we are looking at the latest developments in the Ethiopian market. On the 26th of December 2023, Ethiopia became the third African country to default on its external debt after it failed to make a $33 million coupon payment on its only international government bond. And on the 9th of July 2024, the country's central bank, that is the National Bank of Ethiopia, launched a new monetary policy framework with the primary goal of maintaining low and stable inflation. The central bank introduced an interest rate-based regime with a new policy rate known as the National Bank Rate that was set at 15% and will be used to signal the central bank's monetary policy stance. On the 29th of July 2024, Ethiopia announced that it would float its currency, the Ethiopian birr, and abandon its fixed exchange rate policy as part of wider reforms that were aimed at attracting funding from international lenders. The central bank said that going forward, it would only make limited interventions in the forex market. On the same day, that is the 29th of July, the exchange rate for the Ethiopian birr against the US dollar plummeted by about 30% to 74.73 birr per US dollar. Since then, the birr has continued to depreciate versus the US dollar and is currently trading at 117.17 birr to the dollar. In the month of August 2024, the National Bank of Ethiopia directed commercial banks to restrict the sale of foreign currency to businesses importing non-priority goods. In addition to that, historical data shows that as at the end of 2021, Ethiopia's foreign exchange reserves stood at $1.6 billion, which is less than 2 months of import cover. And in connection with these developments, I have developed a training program that will help you to understand the implication of these changes and the risk management solutions that you need to adopt in order to thrive in the Ethiopian markets. For more information on the training, please send an email titled Ethiopia to jamhurij@gmail.com. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color Podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhurij@gmail.com, Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, your level of attention and involvement will make the difference in your life. Think about it. Thank you, and God bless.